Implied volatility metrics. Aside from implied volatility, which measures the market's expectation of future volatility for the underlying asset and is expressed in the price of an option, implied volatility metrics such as IV rank and IV percentile compare the current implied volatility levels to where they've been historically. IV rank compares the current implied volatility level to its historic level over the past year and quantifies it numerically. For example, if a $50 put option in XYZ historically experienced implied volatility levels from 20% on the low end to 60% on the high end, a 40% implied volatility would fall right in the middle and therefore carry an IV rank of 50%. If the IV rank is 0%, it means that the current level is the lowest of the year, whereas an IV rank of 100% denotes current implied volatility is at its highest level of the year. This statistic is often useful to investors when comparing implied volatility levels between different underlying stocks or gauging the current implied volatility level of a single stock because it more distinctly segments the volatility landscape into measurable metrics that become easier to compare between different assets. Let's assume that based on current option prices, the implied volatility of this XYZ $50 put is 40%. And a similarly priced option on company ZYX carries with it an implied volatility of 20%. If both options are trading at the same premium level of $4, how can investors determine which might provide more relative value? Let's start with XYZ. Based on data from the past 5 weeks, we see implied volatility levels of 20, 30, 40, 50, and 60%. As a 40% implied volatility falls right in the middle of this range, its IV rank would be 50%. Now let's look at ZYX with a 20% implied vol. Its 5-week implied volatility levels are 12, 15, 18, 19, and 20%. Based on this data, we see that the current IV level of 20% is at its historic high, thus giving it a 100% IV rank. With this in mind, some investors might see this as ZYX being relatively more expensive, volatility-wise, than XYZ, and choose to sell ZYX options instead of buying or selling XYZ. This is an example of how using implied volatility rank can inform decision-making processes across different assets by standardizing the framework with which each implied volatility is measured. Just as an investor can be bullish or bearish on a stock, they can also be bullish or bearish on volatility. However, like all metrics, IV rank is a singular indicator. While it can be useful for investors in formulating investment decisions and may be seen as tempting for novices to simply use this indicator when buying or selling, it should not be the sole factor as it does not paint the complete picture. A high or low IV rank can stay high or low for extended periods of time and thus keep implied volatility levels and prices at those extreme levels as well. It is important to note underlying market dynamics as a source of potential volatility and thus movement in the implied volatility as well as the IV rank. Events like earnings announcements, unemployment numbers being released, or even elections can be volatile events that the market forecasts and thus prices accordingly, sometimes far in advance of the event itself. The cousin to IV rank is IV percentile. Whereas IV rank tells investors where current implied volatility is in relation to the implied volatility range over the course of the past 12 months, IV percentile tells investors what percentage of days the implied volatility has been lower than the current implied volatility level. For example, an IV percentile of 60% represents previous levels of implied volatility being lower than the current level 60% of the time, and above the current level 40% of the time over the past year. If an investor believes that statistically implied volatility levels will return to their previous historical levels, which is a concept known as mean reversion, a low IV percentile might indicate a buying opportunity, and a high IV percentile might indicate a selling opportunity. For example, with an IV percentile of 85%, the indication is that for the past year, IV levels have been lower than current implied volatility 85% of the time. If the investor adheres to the mean reversion mindset, they might expect prices and therefore implied volatility to decline in the near term and choose to sell options implied volatility at this time. Of course, different investors have varying opinions about what constitutes low and high implied volatility levels, relatively speaking, and this is what helps create a robust and two-sided options marketplace.